What is up, everybody? Luis here with loanDepot, and happy Thursday. Today, I have some breaking news for you because the Federal Reserve has just decided to hold the interest rates at 5.5%, indicating we may have hit that peak in the economic cycle. But what does this all mean for us, for me, for everybody? Well, it means that we may have interest rate cuts on the horizon. Actually, it's inevitable. It's just a matter of time. But regardless of when they cut the rates, what's important to understand is an easier monetary policy coming. So what does this all mean, right? Well, if you're in the market for a home, a car, or dealing with credit card debt, you know how high those interest rates are, it's going to have a significant impact, a huge impact. Also, if you're an investor, you got to be paying attention to those assets because you're going to have some really nice inflation with your assets, and that's a good type of inflation. Also, overall, the economy is going to really benefit from this. But before we move on, let's go ahead and dissect this, okay? Because the next Federal Reserve meeting is on January 31st. And while they're not expected to cut rates then, like in January, the subsequent meeting on March 20th is where things really start to get interesting. The market has already a 40% expectation of a rate cut in March, though I believe those odds are a little too high. They can seem a little too high. However, by May meeting, expectations skyrocket to 75% chance of a rate cut. And by June, it's a 90% chance that the rate cuts will be here. What's crazy here is that the Federal Reserve insists on higher rates for longer, but the market isn't buying it. And it doesn't lie, just like hips don't lie. And I'm not really sure why I said that. That was, I don't know, some song came into my head. But moving on. Let's get back to it, okay? And let's talk about what I'm seeing despite the high expectations for lower rates sooner than later. Because there are two key factors that play a huge role. So let's pay attention here. First is core inflation. That right now is sitting at 4%. The Feds want this at 2%. So this is going to make it challenging for the Federal Reserve to make those rate cuts. We got to see it back right around 2% or getting closer. Secondly is wage inflation. That's well above the 2% target, and it's currently at 5.5%. I know some of you may not agree with wage inflation being at 5%, but that's what it pencils out to. Bottom line is that as much as we'd like higher wages, from the Federal Reserve's perspective, it's a contributing factor to the overall inflation, right? Higher payroll, well, more inflation, more disposable income. But there are other factors pressuring the Feds to lower the rate. One major concern is the commercial real estate sector, which is facing a refinancing crisis because the rates are so high and it's time to refinance that debt. Also, the struggling balance sheets of banks and other financial institutions. And also, the big one is the government debt situation. That is critical. And as interest costs rise, it puts pressure on the government's budget. So yeah, that little trillions of dollars problem, yeah, cutting the rates would really help. So bottom line, and in my honest opinion, the Federal Reserve will cut rates in 2024, but the exact timing is up for debate. Like, who knows? It's kind of unpredictable. But when it does happen, expect to see a massive boost in the economy and changes in mortgage rates and real estate inflation. So I have to say, careful what you ask for, right? Because for those of you looking to buy a home, this is crucial. Lower mortgage rates will fuel demand, possibly driving up home prices. So if you're in the market, prepare for these shifts. And for those sitting on high interest rate mortgages, refinancing opportunities will emerge. And with that, thank you so much for watching. Share this video if it brought value to you, and have a fantastic day.